In the high-stakes game of market predictions, JPMorgan has donned the hat of the wary fortune teller, casting a somewhat gloomy forecast for the S&P 500. The narrative they weave is not of impending doom, but of caution, peppered with a mix of macroeconomic hiccups and valuation concerns. It's as if they're gently nudging investors to buckle up, for the road ahead might get a bit bumpy. Today, we are talking about JPMorgan saying S&P 500 will fall next year amid a challenging macro backdrop. Central to JPMorgan's prognosis is the specter of a challenging macroeconomic landscape. It's a bit like watching a suspense thriller where the protagonist has narrowly escaped danger only to find new challenges lurking. The economy, which has been resilient thus far, might be showing signs of fatigue. Yet, it's the cocktail of potential recession risks that's adding a twist to the plot. Dubravko Łakosz-Bujas, JPMorgan's chief global equity strategist, is pointing to tangible worries: global growth deceleration, diminishing household savings, and the ever-present specter of geopolitical risks. Add to this the uncertainty of national elections and their policy implications, and you've got a recipe that might not taste great for the S&P 500. And there's more. The valuation of the S&P 500, currently strutting above 18 times forward earnings, seems to be wearing a rather expensive suit, perhaps too expensive for the occasion. This isn't just a passing observation, but a significant red flag, hinting at a market that might be a tad too self-assured in its prosperity. Mislav Matejka, JPMorgan's head of global equity strategy, isn't mincing words either. He sees signs of complacency in equity markets, with the S&P 500 trading close to a lofty 20 times forward earnings amidst historically low volatility. It's almost as if the market, in its quiet confidence, has overlooked the potential cliff edge. There are plot twists in the form of peaking profit margins and the not-so-subtle cracks appearing in the labor market. And if you thought the central bank would play the role of a comforting ally, think again. Their hawkish stance adds another layer of complexity, potentially impacting the S&P 500 as we venture into the second half of 2023. In this ever-shifting kaleidoscope of stock market predictions, JPMorgan Research seems to have spotted a few clouds on the horizon, casting a shadow over the sunny days of stock market gains. As they peer through their economic crystal ball, the forecast for the latter half of 2023 and the dawn of 2024 isn't one of doom, but of caution, with a sprinkle of complexity. At the heart of this cautious forecast is a macroeconomic landscape that's starting to look a bit less inviting. It's akin to a once bustling market town that's slowly bracing for a quieter season. Dubravko Łakosz-Bujas, the sage-like global head of equity macro strategy at JPMorgan, isn't just reading the signs, he's sounding a gentle alarm. The bank's perspective hinges on a trio of concerns: dwindling pricing power, a heightened sensitivity to interest rate hikes, and a risk-reward balance for equities that might not be as attractive as it once was. Think of it as a once lucrative gold mine that's now yielding less sparkle. According to Łakosz-Bujas, the role of multiple expansions in boosting performance so far. It's a bit like a stage actor who's been stealing the show, only to potentially exit stage left in the coming acts. This shift sets the stage for what JPMorgan deems a probable recession, penciled in for the final quarter of 2023 or the opening act of 2024. It's not so much a dire prophecy as it is a word of caution, with a hint of brace yourselves. As 2024 inches closer, JPMorgan strategists are keeping a wary eye on economic uncertainty. This looming uncertainty could rain on the parade of risky assets. And let's not forget Europe, with its earnings growth potentially hitting a flat note in 2024, provided the recession decides to skip its visit. In response to this less rosy outlook, JPMorgan's analysts aren't suggesting a retreat, but a strategic pivot. The advice seems to be to cast a wider net, to look beyond the shores of familiar, top-performing stocks. They're hinting at an international affair, suggesting that investors might find more attractive valuations abroad. It's less about abandoning ships and more about exploring new waters, perhaps in search of hidden treasures in overlooked markets. You can see various factors play their roles with gusto. 3 particularly noteworthy characters, inflation, interest rates, and geopolitical events, are often at the center of the market's plotline with their dramatic performances. Inflation, much like a mischievous imp, stealthily chips away at the consumer's purchasing power. It's the slow but steady increase in prices that can lead consumers to tighten their belts, reducing demand for goods and services. This isn't just a minor inconvenience, it's a real drag on the economy. Businesses, too, feel the pinch as inflation drives up production costs, trimming their profit margins as if on a diet. Then, there's the ever-so-influential interest rates, set by the central banks, playing the role of the economy's puppet master. These rates can make or break the cost of borrowing. Picture this: when interest rates climb, borrowing becomes akin to scaling a steep mountain, arduous and expensive. This discourages consumer spending and investment, putting a damper on economic vibrancy. On the flip side, when interest rates are low, they act like a shot of adrenaline, stimulating borrowing and spending and thus giving the economy a much-needed jolt of energy. Enter geopolitical events, the plot twists that keep investors on their toes. These events range from wars and trade disputes to political instability, each adding a dose of uncertainty and volatility to the market. They're like the unexpected storms that disrupt a calm sea, affecting investor confidence and causing asset prices to ebb and flow unpredictably. Take, for instance, the Russian invasion of Ukraine. This event has been more than just a news headline. It's had real implications, stirring concerns over energy prices and supply chain disruptions. The ripples of such events touch businesses and consumers alike, influencing spending decisions and economic outcomes. Now, onto the stage enters a debate among financial maestros about the future performance of the S&P 500. It's a classic case of differing opinions in the financial symphony. On one side, some experts are tuning their instruments for a somber melody, predicting a decline in the S&P 500. But others are striking a more optimistic chord. Take Anthony Saglambini from Ameriprise Financial, for instance. He's like the optimistic violinist in the orchestra, highlighting historical cadences that suggest consecutive years of stock declines are as rare as a blue moon. He points out that the S&P 500 has had the spotlight on the positive side of the stage about 72% of the time over the last 96 years. Julius Baer steps in with a report that suggests the S&P 500 is a misunderstood protagonist in this financial drama. According to them, it's not just about raising equity capital. It's evolved into a character that's more about returning cash. It's a transformation story, with the index changing its role from a cash-raising to a cash-returning mechanism since the early 2000s. Goldman Sachs Research, playing the role of the confident contrarian, forecasts that the S&P 500 index will not just hold steady, but rise to 4,700 by the end of 2024. This projection is akin to a bold prediction of a sunny spell following a cloudy day, expecting a price gain of about 5%, and a total return of around 6%, including dividends. They're basing their forecast on the expectation that the U.S. Federal Reserve's monetary tightening and the stresses among U.S. regional banks won't spiral into a deeper credit crunch, leading instead to a soft recession. Furthermore, Goldman Sachs Research proposes that quality stocks might just emerge as the heroes. These stocks, with their higher profitability, stronger balance sheets, and stable sales and earnings growth, are like the reliable knights in shining armor, potentially outperforming in a market landscape shadowed by persistent investor concerns about an impending recession. Conversely, when the forecast hints at an economic winter, a recession, or sluggish growth, investors might don their financial coats and scarves, seeking shelter in the more defensive assets. Bonds or stocks in utilities and consumer staples become warm beverages in the cold economic climate, offering comfort and safety. Take Morgan Stanley's forecast, for instance. It's suggesting that the latter half of 2022 might see global GDP growth slowing down, especially in the US and Europe. However, it hints at a more vibrant scene in Asia, with stronger growth, lower inflation, and policies easing up. This projection could be the nudge investors need to pack their portfolios for a trip to Asian markets or to companies likely to thrive under more relaxed policies. However, navigating these economic forecasts isn't always straightforward. Personal beliefs and theories about how the economy operates can tint these projections, making them as varied as the colors in an artist's palette. It's a reminder that different economists can paint different pictures of the future based on their perspectives, leading to forecasts that may carry a hue of subjectivity or bias. For investors, this means treading with caution, seeking out forecasts grounded in objective economic analysis rather than those colored by personal convictions. What do you think, guys? Do JPMorgan's words of caution emerge as the prophetic guidance we heed, or simply another storyline in the vast tapestry of market dynamics?